Now, my focus point today concerns the Wall Street hot streak. We've had a good year so far, but we are entering a cyclically strong period, actually the cyclically strongest period for markets. And this is as we have just come off good returns. And I still talk to investors that are weary that, markets are near all-time highs and not a good time to invest. But history suggests that November through April is the best 6-month window of the year in terms of the stock market performance. The highest average return in that period when compared to any other rolling 6-month stretch dating back to 1945. Okay, so we're talking about any 6-month period during a year or spanning over 2 different years. This is that period. Delivered average annual returns at nearly 7% per year from November through April. And the rest of the year, only averaging 2% returns in the other 6 months. So this is the heart of returns generally. So far, the S&P has advanced more than 16% since April 30th, obviously far outpacing that average of 2%. But what does that tell you about this next period? Was that take away from the gains going forward? Well, since 1945, there have been 12 periods of time that the S&P 500 gained 10% or more in that May to October period. And stocks advanced on average 13% in this subsequent November to April period. So it's saying that, that period can be strong, but in fact, the November to April period is likely to be a bit stronger on average. Okay. And this also is typically a good time for other sectors or other indices like the Russell 2000, as well as emerging markets. Just because stocks are up year to date, low 20% range. Remember, there's a lot of years that have done much better. Last year, up 24%. 2021 are up 27%. 2019, 29%. 2013, 30% over the first 10 months. This is not atypical. So the odds are good that the market will continue to climb the proverbial wall of worry. And the main reason here is seasonality, sure, but actually liquidity. Liquidity remains relatively robust. If you look at central banks around the world, outside of the Bank of Japan, you have pretty much every other central bank easing policy, especially the largest ones, the Fed, the Bank of China, as well as the ECB. Those are the 3 most important, and they're all easing policy. And then you have the credit cycle. The credit cycle continues to inflect positively, showing that we're closer to the beginning of a credit cycle, a positive credit cycle, as opposed to the end of the credit cycle, which would create a bankruptcy cycle. Now, could things change after this November to April period? I think, sure. A lot will depend on government spending. Right? We have a debt ceiling fight probably at the beginning of next year. Ultimately, there will probably be some concessions, and it will be, how big will those concessions be? What will the tax situation look like? There's a new Treasury Secretary. What will that look like when it comes to issuing debt? We know that we're creating a lot of debt out there. So all of these are factors that will impact probably later next year. But if you line up what's happening in the short to medium term, this next 6 months, you get a better than average chance that we will continue to see more gains.